afternoon once again. Yeah, welcome to this webinar titled Bookkeeping and Tax Made Easy for VT and telecom businesses, and basing the new tax law for your business. Thank you all for joining, and your presence shows that you are intentional about growing your business the right way. And I want to especially thank the admin of this group for the privilege given to me to be able to share my knowledge on this platform. My name is Ogunde. I'm a chartered accountant and I'm a chartered tax practitioner with over 6 years of working experience, specializing in bookkeeping, in financial reporting and tax advisory, especially for growing private businesses. I've seen a common challenge with business owners. They have daily sales and they see constant cash flow, but still struggle to understand their profits, to keep their records and to know their correct taxes. This is especially true and applicable in VTE businesses where you deal with stocks that are not handy or physical, and it's quite easy for you to lose track of your records and to determine the actual commission you're earning on daily basis or monthly basis. So that's why we're here today. And this webinar is designed to cut through those confusions and to bring clarity to how to simplify your bookkeeping and your basic tax obligations. So I would like to make it understandably simple and leave you with an actionable principle or plan so that you can begin to execute immediately. So introduction, there's a common myth that says that people say my business is small, so I don't need to do records. Some say because I earn commission, because I earn little, so I don't need to pay tax, which is not true. Bookkeeping is very simple and it doesn't have to be complex before you do the right thing. Proper bookkeeping would help you to spot your losses, to control costs, and to make smart decisions. And the truth is that you cannot manage well what you don't measure. So if you don't measure and keep records, how do you manage your business well? For VTE businesses, it is your incomes are mostly based on commission. So it is very important for you to keep bookkeeping, to keep your records properly and to be able to the tax that you'll be paying. What are the objectives you want to achieve on this webinar? One, we want you to understand the nature of your VTU business finances, then to know the basic records every VTU business must keep. Thirdly, to avoid common bookkeeping mistakes. The other is to understand basic tax obligations that's peculiar to VTU businesses, and then understanding the new tax law and the compliances requirements and how to do without stress and any fear. So firstly, understanding your VTU business finance. How do VTU businesses really make money? How do you recognize your income? You earn money through many channels, some through airtime and data sales, where you sell on behalf of telecom providers, MTN, either Airtel or Glo. So you're acting as a distributor, not as an owner. Your income is just the difference. It's a small margin between what you buy and what you are selling, what you fund your wallet with, and then what you eventually earn from it. For an example, if you sell an item worth 1,000 naira, which you had bought for 970, so your actual income is the 30 naira margin on it and not the 1,000 naira. Secondly, two VT businesses are known to transact bills, payments, electricity and TV subscription and cable subscriptions. And you earn also from it, you earn a small fixed percentage based commission from this channel. Example is when a customer pay 1,000 naira for a cable subscription, whereas you had subscribed for it for 970. So the 30 naira margin is also your income and not the entire 1,000 naira. So in comparing what revenue and commission is, your true income in your business or type of VTU is not the sales you are making, but rather the commission, the margins that you have on each transaction. For example, your sales can be a total sum of 500,000 naira, whereas your income is a margin of, let's say, 8,000 naira. And sometimes customers also fund their wallets, and they keep money in their wallets, which you are holding as a trust. So this money is not even your income, but rather is a liability to you. It is customer money which you are holding in your custody, which is not your income. So if you are mistakenly categorizing this as an income, you'll be doing yourself no good at all. So why does bookkeeping matters for tax purposes? When tax authority comes, approaching you, they want to see your records, and the right thing for them is to assess you based on your commission, income. That's that margin you're earning, and not the entire customer's fund that is in your wallet. Or mistakenly, the two can lead to, massive incorrect tax computation if your bookkeepings are not in order, and it can cause you to pay more, or even cause you to pay penalties if there's any underpayment. I give an example here where we see gross collection of 5 million naira. You have a total sum that was received from customers that was deposited into your account for 5 million naira. Whereas after transaction, each transaction, you hand on each transaction. So after transaction, your total income or commission is 120. So if your books are not in order, and you don't have the right method of recognizing your income, the entire 5 million can be categorized as your income, whereas just 120,000 naira is your income, which it is on that 120,000 naira that should be taxed, and not the entire 5 million naira. So what are the basic books that you should keep in your business, especially for VTU business? Haven't you understood, the importance of bookkeeping? Now, what are the basic things you should? There are 4 essential books and records that you should keep. First is your daily sales record, and this should show you the total transaction volume. That is your Airtel transaction volume, your data transaction volume, and your cable and electricity transaction volume per day or per week, depending on how your platform is capturing that. You might have VTU platforms that as transaction history, you're able to know and determine this, or you have a database that gives you this record at any time. Secondly, you should keep your commission income record. That is a record whereby you are showing on each daily basis, or on a weekly basis, or monthly basis, as convenient for you. That income record should show your actual income hand from each transaction, or total margin you have or discount per day. So this record should show your true revenue, and it is on this basis that your tax should be computed, computed on, or calculated, and not your sales, but rather your commission. Then thirdly, you should have an expense tracker. That is, you keep all expenses, a record of all your expenses. There are running cost expenses that you will incur along the line while you are trying to run your business. Perhaps you are purchasing data, you are subscribing on a website, what are you? So all these expenses, probably for fuel, for transport, for logistics, all these expenses should be well recorded and also receipted, such that it will help you reduce the tax you pay at the end of the day after the expenses have been deducted from your income. And lastly, your cash and wallet movement records. Although your bank statement should help you with that, but you should still have a database showing the volume of customers' wallets or customers' money that is in your custody. Then how should you, or what method will be appropriate for you to be able to keep a record? One is the most simple method, which is the use of manual bookkeeping. That is, you are doing it on a side book or a notepad, and you can make use of an Excel sheets, probably Google Sheets or the desktop version. And you can as well use any of accounting digital tools, especially if your businesses and transactions are voluminous, which will help you automatically generate almost all the reports that is needed. So here's a practical example. You can see on a particular day, this business owner, processed total sales was 100,000 naira for both Excel data and bill. But the commission earned on this 100,000 naira is 2,400 naira. And they had expensive bank charges, internet costs, and what have you of 440. So the take-home profit now is 2,400 naira less 450, which is 1,950 naira. So you shouldn't assume or see that 100,000 naira is your money, but it's just your sales volume. But your take-home profit is 1,950 on this particular day, and it is on this figure on annual basis that your tax will be placed on. The common mistakes that are being made by business owners, specialty businesses, in terms of bookkeeping is: one, they mix personal and business funds together. The first and most common mistake is to mixing personal and business money. Many businesses use the same bank accounts for both their personal spending and their business transactions. Taking money for business wallet from your business accounts, for personal use, and then you want to quickly borrow it and return it later, is not something of good benefit for your business. When you mix personal and business funds together, it is impossible for you to actually know your actual profits, and thereby to be killing your business, because you are taking your capital, you are even taking more than you should be taking. And when you keep doing that, indirectly you might unknowingly be taking customers' funds, and which can be leading to a debt for you or a huge liability. So it is important that you always separate your business money from your personal money. If you want to withdraw for personal use, make sure you record it properly as drawings, as a withdrawal, which should be returned back to the company's account. Or rather, pay yourself a salary on a monthly basis, so that okay, from my salary, I'll be taking care of all my personal needs, and you won't have to interfere with your business, because a business should stand alone as a separate entity, separate from you, the owner. Secondly, we can see that businesses record turnover instead of VT businesses. They record their turnover as their income instead of recognizing that commission, that margin, is actually their income. And also ignoring expenses and charges. You are not giving proper record of your expenses or even receipting them, keeping your source documents. The implication of this is that by the time you are not recording all your expenses, you are not capturing your expenses or tracking them well, you'll be giving yourself more room to pay more taxes, because from the earlier example I showed you, you see the person earned 2,400 naira as commission on this particular day, and then his total expenses is 450. Assuming he didn't record this 450 at all, you'll see that at the end of the day, 2,400 naira will be the basis for tax computation instead of 1,950. So thereby, if you're not keeping proper record, or especially for expenses, you'll be giving yourself more room to pay more, and giving yourself the room to pay more taxes. And as well, it's important that you keep source documents, all receipts, all expenses are receipted, because these are the mistakes that businesses make. They don't keep their source documents, and then when tax authority comes, and then they will request for these source documents. If there are no evidences that you spent those money, it's not justifiable that those expenses should be allowed when computing your taxes. So what are the consequences of poor bookkeeping? One is inability to know your true profit. If you don't keep your books properly, you'll be able to determine your true profit. Secondly, you'll be paying the wrong amount of tax. Either you're paying higher or lower. And if you're paying lower, when they come for you, they give you more liability, that is more tax liability to pay, and it will actually attract penalties. But if you're paying higher, it's not on the good side for business. That money you are giving out to the tax authority, you should have just used it for your business to grow your business better. And if you're not keeping proper records, it's like attract penalties from tax authority and even attract them to come for tax audits. Another is that you'll be able to push your business, for either loan or for investors. And at the end of the day, you're making wrong decisions because you lack the proper books and the proper records that you should have kept. So let's go to tax matters now. Tax and compliances for VT businesses. What are the tax types of what VT business should know about tax? One is you need to understand the Nigeria tax system. This is just an overview of the Nigeria tax. So we have the two tax authorities that are given the power, to administer taxes. One is the Federal Inland Revenue Services. They handle taxes for federal Inland Revenue, and they handle taxes for big companies. That is companies that are in the tax threshold, and they collect company income tax, they collect VAT, and they collect withholding tax. And also have the State Revenue Service. In whichever state you might be residing or doing your business, we have each state has their State Internal Revenue Service, which are responsible to collect personal income tax from employees, which are maybe staff of a company, from self-employed, from business owners, from either proprietorship, business partnership. So far, you're not in the limited category. The State Internal Revenue are the one responsible to collect taxes from you, and there are also so many other tax levels that State Internal Revenue collects. Although the new tax law is trying to bring everything into one, trying to harmonize taxes, there's no different charges and levies that are being collected here and there. So as a VT business, you'll be interacting with both of them. Either both Federal Revenue Service and State Revenue Service, especially if you are a limited liability company, if you're depending on the structure of your business. So registered as a limited liability company, you're paying company income tax, VAT, and withholding tax. But even if you are not registered as a business, as a limited liability company, registered as a business, you can still be interacting with Federal Revenue Service. Probably if you are to remit withholding taxes that are relating to contracts of company limited that you have hired during the course of the year. So ignoring tax obligation does not make them to go away. So if you say, I don't want to have anything to do with tax, I don't want to deal with tax, doesn't make the tax to go with the tax is law, and there's a common saying that anything after death is tax. So you can't completely say no, I'm not going to do tax, I'm not going to pay tax or what have you, I have no business with tax. If they come after you, it will be a big challenge. An important thing to note is tax registration. Once you commence your business, it is important that you register with the tax authorities, these tax administrative offices, so that they can, have your record, and then it will help you to be able to remit your tax appropriately. So if you are a limited liability company, you ought to register with FIRS and also with State Internal Revenue Service. And if you're a business owner, it's important that you register with State Internal Revenue Service. And you'll be issued a tax identity, which will help you subsequently for tax compliances and for your remittances. So the types of taxes you should know, one is personal income tax. So this is a tax that is levied on individuals, sole proprietorship, partnership, business owners, and it is on a progressive tax structure. The higher you earn, the higher you pay. And also, too, you should be aware of the company income tax that is applicable for company limited companies. So if you are registered as a company limited company, you are liable to pay company income tax. And in the previous tax regime, the percentage for company income tax is 30% for companies, for large companies that are having 100 million turnover and above, while 20% for medium companies are having between 100 million and 25 million turnover within the year. And small businesses that was exempted from tax, those that are having 20 million turnover and below 20 million turnover. That ended with December 2020 and December 31st last year. So the new tax law now has changed a lot of things now, collapse the medium and small into one, making them small businesses and small companies, right? Let me use the word business because you have to be registered as a limited company for you to be able to enjoy this tax exemption threshold. So if you are a limited company and you are having turnover, that is your total sales. I mean, for VT businesses now, your sales in this term is your commission you are earning, not the total value of airtime or BTU or bills that you made, but the commission that is your own. So if your commission within the whole year is not up to 100,000 naira, as a limited company, you're not going to pay any taxes. It is pegged at 0% tax. They're exempted from tax, but provided your fixed asset is not more than 250 million naira. And for companies that have more than 100 million naira commission, so let me be specific now to BTU, 100 million naira commission, they'll be paying a tax of 30%. So, but for businesses, for individuals, staff, salary earners, individuals, sole proprietorship, or if you register your business, your company, your business as an enterprise, you'll be paying personal income tax and not company income tax. And it's on a progressive rate, which we'll be looking at further later in the course of the webinar. So also, you need to take note of VAT. VAT is a consumption tax that is still at 7.5%. The rate is yet to be changed. So it's an indirect consumption tax on goods and services. And we have essential goods that have been exempted from VAT. That is, it's zero VATed. VAT should not be charged on food items, on education, on medical, and many more. But there are some items that are still VAT inclusive, which is like the sale of properties. You are leasing out, when you engage hotel services, or you are buying luxury goods, and even consultancy services and telecommunication services. So for example, if you're hiring a consultancy, VAT is inclusive of the charges that will be collected from you. And if you, for example, like legal service or even a financial consultancy services, be expecting that you'll be charged VAT. So as a business owner, your business, you are to be deducting VAT from your customers. If for VTU businesses now, under telecommunication services, VAT is applicable to VTU business. Now coming on to capital gain tax, which is also part of the taxes that are being collected here in Nigeria. We see that capital gain tax are the taxes that are charged on the sale or disposal of capital assets. So for companies, the rate is at 30% currently, or it's previously at 10%, depending on the kind of property. And then for individuals, the tax will be paid that you should pay on that sale, on the gain. Now, let me emphasize on the gain of the sale of the property will be based on the progressive personal income tax rates. And also, you need to take note of withholding tax. Withholding tax is a form of advanced tax that is charged on income taxes. For example, you are hiring a contractor to do something for you in your business, or you are being contracted for somewhere else outside your business. So you should be expecting that withholding tax to be applicable, provided such companies are under large companies. That is, we have turnover of more than 100 million naira. So withholding tax is applicable. So in your business, please, it's essential that you take note of this. If you are hiring somebody to do something for you in your business, for whatever purpose, so as far as it's a contract arrangement, if that person you're hiring or that business you're hiring is a large company, is under the category of large companies, you should deduct 10% withholding tax from whatever you are paying. If you are paying that person 1 million naira, you should deduct 10%, that's 100,000 naira, and you pay the person 100,000. So the 100,000 naira will be remitted. It's not your money, you're not to keep it, but you have to remit it to the tax authority, FIRS. They will give you a receipt, which you will give to the contractor that you have deducted from. And by implication, if you are not deducting this, and the tax authority come for you, they will collect that money from you, the business owner. Rather, you should have collected it from that contractor. So they will collect it from you, and then it's also attract penalties. That is, if you pay more than 100,000, you pay the actual 100,000, and then there will be penalties that will be attached. So you pay more than 100,000, which you should not have even bothered yourself about it at all. It would have been the supplier that will have been the person to pay. So let's come to the new tax law. Let's try to to see what the new tax law is and the changes in it. One, the small companies threshold, exemption threshold has been increased from 25 million, because previously small companies are known as companies that have turnover of 25 million below, 20, either 25 million or below. So previously, if your company is doing turnover of 25 million and below, you're not to pay taxes. And for medium companies that are doing turnover of between 25 million and 100 million, they are paying 20%. Now both have been collapsed and collapsed into a bracket called small company. So any company that is doing below 100 million is categorized as a small company, provided that your total fixed assets value is no more than 250 million. So you are categorized as small companies and you have to pay zero tax as companies, that is as limited liability company. I'm not talking about business owners now. So as limited liability company, you're not going to pay any CIT, that's a company income tax, you're not going to pay capital gain tax, you're not going to pay, or you should not deduct or pay VAT, neither should you deduct or pay withholding taxes. But for large companies, so as far as you are doing a turnover, that is your commission for the whole year is more than 100 million, then you are categorized as a large company and you pay 30% company income tax, and capital gain tax will be applicable, and also VAT and withholding taxes. So tax rates on capital gain. Capital gain taxes are taxes that you pay on the sale of assets, on the sale of properties. So previously it was at 10%, but currently now it has been increased to 30% for large companies. And for individuals that are selling properties, their tax will be it is the progressive tax rate for personal income tax that will be used to calculate the tax that they have on that gain of the assets, not the value of the asset, but the gain you have on the assets. Also included in the law is that sales of shares in Nigerian companies has been increased. The threshold has been increased to 150 million from 100 million within 12 consecutive months, provided that the gain you're having on it is no more than 100 million. So capital gain tax for large companies, I've explained this earlier, is at 30% if you are doing more than 100 million naira turnover, compared to the to the old law regime of 20 million for medium and 0 for small companies. Also, there's an introduction of development levy. Previously in the old system, you can see that as for large companies, they pay additional taxes like 3% tertiary education tax, they pay 1% information tax levy, they pay 0.2.5 for national agency science and engineering infrastructure, and then they also pay police trust fund. So all this has been collapsed into one, and now it has been said that 4% of your assessable profit. Assessable profit is when you say your taxable profits. The taxable profit before you consider depreciation of any trading loss. So 4% of their assessable profits will be collected from large companies. Small companies are not included. They are not going to pay any developmental fee. Limited liability companies that are within the small company definition. For personal income tax, as I said earlier, is applicable for individuals, for salary earners, for business owners, for individuals, for self-employed. So, or business, if a business or company is registered as a business, it is personal income tax is applicable. So if you're not, if your business name is not limited liability, personal income tax is what is applicable. And the bracket now is that those are earning below 800,000 naira in a year. So in your business, you calculate your profit at the end of the year. That is your commission minus all your expenses. If your net income is below 800 naira, that is 800,000. That is what you're taking home with is below 800,000. Be it a self-employed or a salary earner or business owners. If it's below 800,000, you're not going to pay any tax at all. So now let's look at the difference between the tax rates for personal income tax. Previously, in the old tax regime, the gravity rate is starting from 7% for the first 300,000. So in the previous tax law, anybody that is earning 30,000 naira in a month, would actually pay tax. But those that are now earning up to 30 million naira in a month were not paying any tax. But now, you can see that if you are earning below 800,000, so the tax person I mentioned earlier is for 360,000 in a year. So somebody who is earning 360,000 naira in a year, and the whole tax law that ended December 31st, not paying any tax. So those are earning below 360,000 are not paying any tax. But those that are earning below 800,000 naira are not going to pay tax. So the threshold has been increased from 300,000 to 800,000 naira exemption. So this is the graduating rate. I'll be giving you a proper illustration later on. So this is the current graduating rate for the first 800,000 naira of your income. It is at zero tax. Then the next 2.2 is at 15%. The next is at 18%. The next is at 21%. And the next 25 million is at 23%. Why the highest rate of 25% is those are earning above 500 million naira within the year. So let me give you a proper illustration. I would like to open that link now so that you can see. So here is a practical illustration for personal income tax. So I gave an illustration for somebody who is earning 1.5 million naira, 2 million naira, and 3 million naira in a year. Let me try to share my full screen. Okay. So this illustration, we have reliefs that's included. Previously, in the last regime, the consolidated relief was 20% of your gross plus 200,000 naira, but that has been taken away now. Now we have relief of rent relief and 800,000 naira relief. So if for a salary earner or business owner, if you are paying pension, is a relief for you. If you are deducting National Housing Fund, probably you are contributing for National Housing Fund, is a relief for you. And if you're also contributing for National Health Insurance Scheme, it's also a relief for you, provided you have a document to prove all these deductions. So these are deductions, they are like relief or allowances to reduce your tax or what should be taxed. For someone that is earning, at the end of the year, you did a profit or commission, net commission of 1.5. So if you are doing all this deduction, you would if you are doing pension or national savings forward, or either it might not be three of them, it might be just one. So any of these deduction that you have that's applicable to you will first deducted from your 1.5 before the tax rate is placed on it. So let me dive into it. So if you look at the old tax law now, for somebody earning 1.5, the first deducts pension. This person's pension for the whole year is 120,000. Whereas it also did a housing fund contribution of 37,500 naira within the year and health scheme of 75. So these three funds will be deducted from the 1.5 million naira. Sorry, yes, we deducted from 1.5 million naira. But before that, in the whole system, you see consolidated relief allowances, which is 200,000 naira plus 20% of the net, that is 1.5 less 120 less 37 less 75. So once we deduct that, we have 1.3 left. So 20%, the considered relief is 20% of that 1.38. So that will be 1.5 minus 476 naira. And you see how the tax is being computed now. So what should be taxed? Is it 1.5 that will be taxed or or after deduction? So after deduction, we have 891,500. And so it is on this 891,500. It is the 891,500 that will be taxed, not 1.5 in the whole system. So then this graduating rate to be placed, this 895, this what's usually done, you take the first 300 of this 895, that is 300,000 naira, multiplied by 0.7%. So 21 year, then the next, because the taxable, let me put it there. So we say that the taxable income is 891 naira 500. Out of this 899,000, we see that we have 300,000, 300,000. Then you'll be having balance that will be under this 15% range. So the first 300,000 of this 891 will be taxed at 7%. Then the next 300,000 of this 891 will be taxed at 11%. I've deducted 800 and I've deducted 300,000 from, so I'm having left 551 500. So that tax applicable is now will be still 11%. 11% multiplied by 300,000. So after deducting 300,000 here, we still have balance of, that's 891 500 minus 600. So you have balance of 291 500. So this 291 500 will be taxed on using 15%. So let me come again so that you can understand better. Earlier, I said somebody earning 1.5 million naira in a year as relief, as its various relief, but somebody is not compulsory. Not everybody has relief. So if you have this relief, it will be deducted. Then your consolidatory relief also to be deducted. And what will be charged, what will be taxed, and the taxable at 851 is taxed at 11%, and the next 500,000 out of that 851 naira is taxed at 400. Is taxed at 15%. So the total tax for the whole year that this 1.5 income earner is 97,725 naira. So the same as 200, same as somebody earning 2 million, all the pension will be deducted, the consultancy relief will be deducted. Then we'll use this graduating rates to compute based on 1.1. So somebody earning 2 million will not be paying tax on 2 million. All deductions will be taken. Then what is left, the taxable income, is what the tax rate to be on. So I don't want to emphasize more on this old tax law. Just let me come to the new tax law so we understand what we are in for 2026 going forward. So using the same figures and the same salary figures, or let me use your salary, your income of 1.52 million. What is the new tax law saying? The new tax law still gives room for these pension deductions, NHI deductions, and NHIS deductions. So all these deductions are still in place, but the consolidated relief fund of 200,000 plus 20% of your gross income has been taken away, has been removed. So we don't have this consolidated relief anymore. All we have is rent relief. So the government is trying to relieve people of their rents, provided you are a tenant and not a landlord. Provided you're a tenant and you pay rent, and you have your evidence that you are paying rent, you have a receipt that you actually paid rent. So what did you pay? How much did you pay? Whatever you are paying, multiplied by 20%. So the relief is 20% of your rent, and it should not be more than 500,000 that will be deducted. Thousand naira will be deducted as a relief. For somebody who is paying rent of 1 million naira, 20% of it is 200,000. So instead of 60,000, that person will be having a relief of 200,000. So then the tax is not saying that you cannot take more than 500,000 naira rent relief. That is, for you to be able to claim 500,000 naira relief, it means you are paying rent of 2.5 million naira in a year. So you have to prove to the government that you are paying rent of 2.5 million naira in a year. Now imagine somebody who is earning or who have income of 1.5 at the end of the year. Now say I'm paying rent of 2.5. So before you can pay 500,000, you also have the tax authority to contend with. So you need to be sure of what you are doing. Your tax receipt must be handy for you to present, and then what you are claiming, you should be ready to prove what you are claiming, the amount you are claiming as rent relief. So I'm going to make sure so that we can have a proper understanding and also, make attempts to compute that tax on your own. So for somebody earning 1.5 million and spending 300,000 naira rent, 60,000 naira rent relief, and this is what will be done. The tax rate will not be on 1.5, but rather all these deductions will be taken in 120 pension, NHIS, NHF, all these deductions, and then the rent will be deducted. So what is left for to be taxed is 1.2. So the tax rate will not tax you on 1.5, but they will use 1.2 to tax you. So they will say your taxable income is 1.2 and not 1.5. Same as somebody earning 2 million naira at the end of the year, the business owner, your profit or commission at the end of the year is 2 million naira. You have all these deductions, and your taxable income is 1.6, not 2 million naira. Then for 3 million naira profit or business owner, the person will be having 2.4 taxable income and not 3 million naira. So it is on this taxable income that the new rates now is the first 800,000 has been exempted from tax. Then the graduating rates of, let me come there now so that you can see. The graduating rate now is the next will be 15% of 2.2. Then the next is 18%. If the person is earning if the person have taxable income of up to 9 million naira, the person have taxable income of up to 30 million, the person will pay rates of 21%. No, it's a graduating rate, just as I've illustrated earlier above. So this graduating rate will not be applicable, and then at the end of the day, the income earner or salary earner of 1.5 will be paying tax of 16,000 naira. Somebody of 2 million naira will be paying tax of 124,500, and somebody of 3 million naira will be paying 280,125 at the end of the year. So this is for the whole year. So if you want to pay on a monthly basis, you divide it by 12. Then that's what we remit on a monthly basis. But for self-employed, you usually do yours at the end of the year. Now this is a new year. This is January 2026. So all what you did as for self-employed and business owner, all your income for the whole of 2025, you should calculate them. So if you are keeping proper record on daily basis or monthly basis, it will be easier for you to do that now. So before the end of March, all business owners or self-employed should file their taxes and make payments for the last year tax that is charged on their income. For those salary earners, it's usually deducted on monthly basis. So but if you are self-employed, you don't do this on monthly basis, or you're a business owner, at the end of the day, you calculate, compute your tax, and then send to the tax authority, remit your tax appropriately, so that you have any penalties that will be levied on you. So it's important that even if you are claiming a tax relief, you should have the required documents in place. So I would like to conclude with tax filing. Now, what is tax filing? Tax filing is a mandatory requirement that every taxable person should, oblige to. That is, tax filing means just declare your income. For a self-employed or business owner, you just you fill a form to say, okay, this is my total income in the whole of 2025, for example. Then you compute your tax, and then you make your payment. So that's what tax filing is all about. And understanding to help you to prevent a lot of problems for yourself, for your business, so that you don't have penalties that are, accruing to you. These are expenses that is avoidable. So who are those that should file now? Everyone with income or business activities. You are earning an income, you're exchanging values for something, you are being paid in return in exchange. You have an income, or you're in a business. Everyone is expected to file and pay their tax. So even if you are not within the taxable people, you are below the tax rates, the 800,000 naira, you should still file. You don't say, because I don't have any tax to pay, then I'm not going to file. No, it is compulsory that everyone file, so that they know that truly you are not within that bracket. And even if you want to come to observe to examine, everybody must file whether you are in that tax bracket or not. So that's the when and when should you file? You should file for self-employed. You should file before March 31st of every new year. So this is a new year. Your 2025 records or your business activity, you should file that before March 31st of this year. That's for 2025. And for businesses like companies, you should file on behalf of your staff before January 31st. So individuals now, business owners should file before March 31st. But for companies, limited companies or corporate businesses that have staffs that they are deducting tax from on a monthly basis, you should file on behalf of your staff on or before January 31st. So please, let's put this in place, especially for this year. And CIT now, company income tax will be filed before June 30. That is, you have 6 months in the new year. Between January this year and June, you should have closed all your books of your 2025, do all your calculations, know what your net income is, your net profit is after your direct tax, and then calculate your tax you should pay, and then file with FRS. They have a platform which can be done online, Tax Pro Max. Once you are registered with them, you can do all this filing online. And VAT too also should be filed on monthly basis. So you don't wait until at the end of the year, I'll go and pay my VAT. No, it is on monthly basis that VAT should be remitted on or before the 21st of the following month. So for December last year now, all your sales, the VAT you have collected from your customers should be paid in before 21st of January. So it's a monthly basis. And if you don't file, the implication is that penalties will be attracted interest, and then they can come for audits. Excuse me. So I've come to the end of this webinar and this lecture, and I would like to give them for questions and questions. So you have any questions, you have anything confusing you, you can keep it coming. So if you have any question, you can indicate or put it in the chat box so that it will be addressed. Okay, we have Ayo Yusuf raising his hand.
Yeah, good afternoon.
Good afternoon.
And well done for this webinar. It's an insightful one, and I must commend your effort. However, I have a question. So now you kind of say, okay, your actual revenue is the commission that you earn on transaction on a daily basis. So I want to ask, if let's say you have you are keeping your record, you are putting everything in order and everything is set, and now on your income statement, what do you put there? Do you put the income? Do you put the commission earned as revenue, or do you put your total sales against your cost of sales in your income statement? Do you get the question?
Yes, I do.
All right.
Yeah, your question is on your income statement. When you are recording your revenue, what should you recognize? Now, you earn commission. So what you should recognize?
That's what I was asking. Yeah, I felt like it's somewhere. Yeah.
Question, kindly unmute yourself. So if you are not, sorry, if you are doing your income statement now, it's only your commission, the margin you are earning that you should record as a revenue. So it is that commission you record as a revenue, then take away your expenses. What you have left to the net commission, or you call it net income. So this is on this net income that your tax will be charged on. I'd
Okay,
like to
so
know if I have
you're
answered your
saying there's
question.
no need to. Yeah, so yeah, I get that. So you are saying there is no need for you to record your sales against your cost of sales. You can just take your commission hand to be your revenue straight away, and then you treat all other expenses from the commission you have earned.
Okay, let me ask. You do VTU, right?
Yes,
And your business is your hand commission, isn't it?
yes,
So you are funding your wallet, isn't it? And then
yes,
adding a charge, adding a margin to it for your customers to be able to enjoy those services, isn't it?
yes.
So it's a form of, for as regards this area of business,
Mm.
cost of sales doesn't really apply to you. I'm not saying you should not record or keep record of your sales volume, but cost of sales doesn't really apply to you here, because it's only that commission that you're earning that should be recognized as your income. So you should keep proper records of your sales volume, the way the monies are moving from one wallet to the other, what have you. But what should be recognized as your own revenue to save yourself stress, and for your business properly is to recognize that commission as your revenue. So you should still keep all books, all proper records handy, so that when you have to make reference to them or make decisions based on those records, it will be easier for you.
All right, that's fine. Thank you.
You're welcome. Okay, we have Prince IG.
Good afternoon, ma.
Yeah, good afternoon.
Thank you for wonderful presentation. We are grateful for that, ma. I have three questions, ma. Number
Okay.
is about BAT. Ma, as you know that the NCC has signed agreement with Federal Revenue that they will going to withdraw their BAT directly from service provider. I think it is around 2021, if I'm not mistaken. So shall we still recollect BAT again?
If you are able to prove that your service provider, whom you are purchasing with, you as be deducting VAT from you, there's something called input VAT recovery. That is, you'll be able to recover whatever excess you are paying, if provided you have been charged VAT already. So whoever you're supplying from, you should have evidence that this person has deducted VAT, and then you would be able to enjoy input VAT recovery.
Okay, thank you so much, ma. And then, ma, please, we don't know whether you can help us with this slide so that it may guide us.
Okay, no problem. We'll have it gotten across to. And if you need any, inquiry, any help, the phone number is already attached and email, so you can reach out to any person.
Okay, thank you so much, ma.
You're welcome. You mentioned you have three questions. You mentioned two. Just a third one. Oh, we should go on to
Yes,
the next
and apart from that, ma, when are we going to upload? Is it like Excel and only our revenue or commission that we are going to show to Federal Revenue when we are going to fill the form at the end of the year?
Come again, please.
I say at the end of the year, when you are going to fill your text, are you going to only show them the record of your commission, that is the revenue, not of your volume of transaction and other expenses?
What they will see the volume of transactions in your bank statement. They see how money moves in here and there. They see how customer fund your wallet. So there's nothing you can hide from them. As much records they ask from you, just make it available for them. So but the only thing is that if you're not having proper books in place, it's very difficult for them to work with you, and they can as well use best of judgment. They can just use their data and say, okay, fine, because you don't have something we can use to calculate. They can just give you any figure and say, this is part you ought to pay. But once you have your books in order, whatever they ask for, you make it available to them. And if they are saying, what about this sales, but you make it understand that these are customers' money in my custody. Customers fund their wallets. Excuse me, just like OPay and money point businesses. That people fund wallets and then they can use the money in their wallet, either transfer it out or buy airtime or whatever. So these are personal money in your wallet. This is not your own money. Your actual money is per transaction. So also you must have document that is proving that this is how you get the agreement you have with your vendors, probably with Gola or what have you. You are able to prove that okay, this agreement we have on this agreement document shows that this is the rates or percentage that I earn as commission on each transaction.
Okay, thank you so much, ma. Understood.
You're welcome. So we have P. Sadedokun raising his hand.
Okay, thank you very much for that fantastic presentation. So my question would be a bit of a follow-up to the earlier questions asked. So although you have answered the first one that you need to be able to show them that these are customer funds and not your own. Now, so the next question would be on the issue of VAT. So you talked about we being able to claim input VAT. So let me paint a scenario. Now, in V2 business, we have people connecting to multiple providers. So some website can have vendors, like up to 10, some even have 20, even plus, that they buy from at different times, in the bid to chase rates and better commission and all of that. So now, how do you, come to terms with paying VAT in that kind of situation? That's one. Then the other one is generally airtime data are usually VATed from source, which means that MTN, Glo, and the rest of them have, as in the airtime we buy, are already VATed. All right, but we don't have access to that as an input VAT. So how do we handle that in that kind of situation? Then the second question is on the issue of you talked about still on this VAT, you talk about the agreement you have with your suppliers. So in this case where you have a lot of people, so how do you start getting an agreement from different people that, oh, have you paid VAT for me? Have you paid VAT for me? And so everything kind of becomes so messy. Maybe you can throw more light on that angle.
Okay. The first question is input VAT, right?
Yes, please.
Okay. So input VAT, for VAT is a consumption tax that is actually charged. Okay. Excuse me, please. Yeah, so VAT is the consumption tax that is charged on each level of transaction. So that is why it is, although on this particular thing, it's still a controversy that we're still having with the tax authority, whether VC businesses should still be paying VAT, despite the fact that MTN is deducting VAT directly from the users. But it has been said that VAT is a consumption tax that is charged on every level of exchange of value. So that is why we are still liable to pay VAT. And your question is saying that how do you relate with your vendors to be sure that they have deducted VAT? All vendors that are seen and they're deducting VAT from you, what you just need to do is just collect their TIN number. And if you are filing with FIRS, if on the tax format, it's there. If you're filing for VAT, it's there that input VAT, and just input the TIN number of your vendors, amount they are deducted from you, and the difference is what you'll be paying.
Okay, so that's if they charge VAT on an invoice, right?
Yes.
So what exactly what exact VATs are we as VTU vendors now supposed to be paying? Are we supposed to be paying VAT on the commission we make, or what exactly?
Yeah. So for VTU vendors, if your company or your business name, I don't know the structure of your business, if you're registered as a company and you're among the large companies, you are expected to deduct VAT and also make payments. But if you are below that threshold, you are among the small companies of less than 100 million turnover, you are not supposed to even deduct VAT or pay tax. So, but if you're in that category of paying VAT, what you should do is to there's a formula anyway that I usually use. We calculate backward by saying that, okay, if your commission is on 1,000 naira, so instead of saying 7%, let me use an example so that to be easier for better understanding. So what I do is to say 7.5% divided by, I will add 100, I'll divide by 100, but that 100, below that 100, I will say plus 7.5, that is 7.5 divided by 107.5. That's be giving you 0.07 multiplied by your commission. So multiply by your commission, we give you a figure. So let's say 1,000 naira. Multiply by 1,000 naira, that should be around 7. Let me see, multiply by 1,000 naira. I'm doing using calculator, please. So that is 6977. So what you should recognize as your income now is not 1,000 naira, but you will say your income is 1,000 naira minus 69.77. So your commission now that you are taking home with is less, is just 900. That's 1,000 naira minus. So that's 930 naira 23 kobo. So your commission is 930 naira because you have deducted the VAT that is for the government.
Okay, so whatever profit we make, we deduct VAT from it. Then whatever is left after deducting the VAT is what we now record as revenue.
Yes, exactly.
Okay, thank you.
You're welcome. So I think there's a question in the comment section. Someone is saying, on every game you make 15 naira, you pay VAT on it. Okay, so I think that's just a comment. How do you get presentation slide? I will have it sent to the admin who will share it on your group chat. Okay, there's another question. The commission turnover, how would government be sure what I'm keeping is correct? Okay, once you do your filing and then you make your payments, they can start come for audit at any point in time. Although they don't have capacity to chase everybody in the country 100%. So, but mostly they target the big companies that will give them pay, because they also have a target. The government give them targets of what they should bring in as generated revenue. So mostly they go for large companies. So if you fall into that category, just be sure that you need a professional that will really help you out with that, so that you'll be able to compete correctly and remain. So now the question is, how will government be sure that what you are doing is correct? Well, it's left for the government or the tax authorities to to work on that. They ask for different records of files, your commission, how they sit down with you and they will try to understand your business. They try to understand how you recognize your income. Then they can do a check on their own. Probably they visit you on 2 or 3 days so that they are with you. They check that what you are doing is accurate. And sometimes they even give guidelines on how to do things better for your business. So they are not all about going after taxes also too. They also help businesses so by giving them their own advice, contribution to be sure that taxpayers are doing the right thing. So how to know is for them to come for an audit, they come for a check, a review, and then they also dialogue with you to be able to come to a final conclusion. For that question asked by Awokayo, because I believe I've answered your question. Is anyone okay? Someone is raising a council room.
Okay. Good afternoon. Thank you very much.
Good afternoon.
Okay. Mine is just okay. Ever since I've not paid tax until this new tax policy that is coming up, and I think I've operated my business for about 3 years now. And to be very honest, there is no way I can actually go back and calculate. Since I'm not keeping proper book of accounts, and there is no way I can actually calculate my profits in the previous year so as to pay the backlog. So in our own case, people like me, what can we do?
Okay, because you have actually at commencement, you should register with tax authority and then begin to pay immediately you commence business at the end of 12 months. That is a year period. But since you have been staying for 3 years, you have not paid any tax, you still need to register with tax authorities.
When you
Yeah,
say okay, when you say you register with tax authorities, is it not when you go to FRS you get 18, or is there any special registration?
yeah, you open a file with them. You can relate to them once you enter the office. You open a file with
Okay,
them.
you have to open a file with them.
Yes, exactly. Then they will
So
give you a login detail. They open a login detail for you on their um, online platform called Tax Promax, whereby you are able to remit your taxes, make payments online, file online without visiting the offices on regular basis. So
okay, so what
that's
if you have not done that before? If you've never done that before,
you still need to visit them.
and so if you visit them now, you've never done that before for your previous years. So after visiting them, how will you now calculate your tax based on the fact that you don't even have these things, books of account?
Proper records. Yeah. So I was coming there. Once you visit them, that's you are presenting yourself to them that you're a business owner and you've operated. So they will have to see your commencement dates. So you give them your
Okay.
commencement date. If you want to do the right thing, you
So
give them
when
the right dates, give them your commencement dates. And if you don't have proper records, they can use best of judgments to give you a figure and say, okay, pay for the years you have not paid. Do you understand me? Because you don't have proper records. So it's just a disadvantage that you don't have proper records. As when you have proper records, you're able to prove that okay, this is actually what I'm supposed to do. So if they give you a bill of 700,000 naira for 3 years, but as when you've kept your records properly, probably your tax should not be up to 300,000 naira that you should have paid for those 3 years. So that's what
okay,
the best thing they will do than to use best of judgment for those 3 years. But then going forward, we begin to the right thing so that you don't attract more penalties and overpayment of tax.
okay,
Subsequently.
but after paying for those previous years, can it be disputed in the nearest future?
You have a receipt. Once you make payments, they will be giving a receipt to show that you have made payments for those years.
No, though you are having the receipt, what I mean is that can it be disputed in the nearest future? Probably maybe someone comes on board, probably come and check your business for, let's just say, starting from this 2026 now. Then maybe what they will not tell you that what you filed the previous years was not the actual amount you actually filed.
Okay, I understand you. There are attached documents that you should keep. They will write you. So it's not like on
Okay,
verbal. So they will write, they give you documents. So if somebody else come in some years after, you can present this to them. I was doing better judgment, I made payments and this and this and that. So
okay. Can the tax be paid? Must it be in your state, or you can pay it anywhere?
for limited company,
For business name.
business name, you will pay it where your business is residing.
Okay, then for limited liability.
That's to FIRS. If you are to pay company income tax, you pay it to FIRS. So FIRS is federal, it's everywhere. But if
So
you're a limited company that has staff members and deducting payee from them, your payee, you need to determine where your payee are residing. Where did they lay their head? So it is where your staff members are living, residing, that you pay their taxes to. For example, if you're operating in Lagos State, you have 5 staff, you are paying their salary, and 3 of them are residing in Lagos, 2 residing in Ogun State. So the payee, the tax you deduct, you remit for 3 staff residing in Lagos to Lagos State Revenue Service. And for your 2 staffs that are coming from Ogun State, probably they are working remotely or they are, Lagos also, and they come from Ogun State to Lagos to work every day or on hybrid basis, you remit their own tax to Ogun State Internal Revenue Service because that's where they reside.
Okay, thank you very much.
Yeah, so you might need help. You know, that's how to go about that.
Yes,
Help.
I'll need help. Yes.
So I will drop contact is attached with the slide. We will drop into the admin to share with your group.
All right, thank you.
You know, I'd like to know if you have entertainable questions. Unmute yourself. Okay. Comments. Okay, somebody's asking, what if I don't have a physical store for my business? For instance, 80% of my business are online. Only few have office. Okay, so whether you have a physical business or not, now the next person you know have apps are online remote workers that are earning billions of naira and they don't have a physical office. You know, you transact. First of all, tax is on income. So far, you are exchanging value. So whether you have a physical store or not, you are still liable to pay tax as far as you earn income here in Nigeria. So if your staff are remote workers, you are paying them salary, you should deduct tax. So the tax, the salary you are paying them, is it above 800,000? Is it, you know, are they within the taxable bracket for the whole year? If they are, you should deduct payee and remit on their behalf. I've checked through the comments now. I'm not seeing any more questions. I'm still giving a few minutes for anyone, any question in the group. So as I said earlier, the slide will be given to the admin so that it can be shared with everyone in the group chat. I really want to appreciate everyone who has joined this afternoon, giving your time to, you know, listening to this webinar. I believe you have added more knowledge in terms of bookkeeping and taxes that you need to know. And my contacts will be attached in the slide. So if you need any question or you need to reach out or for our services, we are readily available for that. So bringing the meeting to an end now. Thank you all.